Hello and welcome to ET Now Special. Over the next couple of minutes on ET Now, we would be debating, discussing and ideating that at a time when markets are at an all-time high, global investors are pouring into Indian equities and exhibiting their leap of faith. Why exactly are domestic institutional investors or DIIs feeling the heat? When markets are soaring and roaring, historically the retail investors, they tend to buy, but looks like the retail investor this time has decided to redeem. So what has really been the reason of net outflow of more than 20,000 crore in last couple of months? Is this a temporary and a transient trend, or this trend could really spill over to next quarter as well? To discuss what are the compulsions and what are the opportunities here, I have with me a perfect panel, three industry veterans, Nikesh Shah, Swarup Mohanty and A. Bala. Gentlemen, fantastic to have you back on ET Now. Thank you for joining us. Nilesh bhai, let me start with you. The triangle historically has been markets go higher, FIs they buy, and DIs or retail participation is follows. But right now, the ends of the triangle are not matching, which is markets are soaring and roaring, FIs are pouring in, and domestic investors are selling, and they're selling at a record pace. If data is anything to go by, we've got record outflows of nearly 20,000 crore in last couple of months. What is causing this?
In the month of March, there was record outflow by FPIs, record buying by domestic institutional investors, and markets are at all-time low. I think if I have to choose the triangle, I will always choose March over November, when markets are at all-time high, and if my investors are booking profit, so be it. But definitely at the lower level, I will be a buyer rather than seller. Having said that, yes, in the month of November, like October and September, we have seen some profit booking by our clients. We have seen redemptions by people who were in financial need. As industry, we have seen some institutional investors taking asset allocation call. But I would like to reassure investors that this is not selling by our fund managers to increase cash because they believe market is expensive. If at all we have deployed cash balance in the market and our cash levels have remained virtually stagnant over last 8-9 months. So we are selling because our investors are putting redemptions. It is not a call on the market.
Bala, what is causing this redemption? Because the psychology of the investor always is that you normally want to participate when markets are going higher. And the fact that benchmark indices are at an all-time high, it should be inviting more participation, not redemption.
One of the reasons that one could probably think about is the way we saw a fall in the market post-COVID declaration in the month of March. Very sharp fall came. So one cannot forget that it was a scary momentum at that point of time from the market reaction point of view. And that's something which I think the market, the way it bounced back. I think if you look at from the low that we saw, where people are a bit worried, that I still remember being part of the same show along with Nilesh and few other industry players and giving the assurance to the people that, not more than assurance, giving some kind of comfort to the people that this is a one-time big fall, is adjusting to the COVID situations and market will come back. And the way I think the regulators are taking steps, therefore the confidence will come back very soon, which has happened. Now, having seen such a seesaw momentum, and probably I would assume some element of portfolio allocations could actually happen between one asset class, other asset class, as Nilesh mentioned. That's one. And secondly, if you look at people are deeply in money before COVID, any investment that you have made in equity would have given you a significantly higher return or substantially higher return to the satisfaction of every investor that would have come into the equity. But the post-fall, they also saw some bit of valuation thanks to the market. But now having seen that coming back, probably the set of investors would assume that maybe it's a good time to reallocate my portfolio one to other. So that's, I think, the function of that. And is it actually unique to this time? To some extent, it is unique, we can say, because of COVID. Otherwise, even historically, the similar situation we have seen in the past. But ultimately, the winner always in the market is somebody who stays invested. As Nilesh was mentioning, that the investors, while they have to relook at the portfolio allocation and so on and so forth, etc., another way, somebody who stays invested in equity is the one who will ultimately benefit out of the purpose for which he is putting the money. And therefore, the current situation is largely on account of the market gave a very beautiful bounce back from the bottom. And that maybe make people think that maybe it will be take some money on the table as part of the asset allocation.
Mr. Mohanty, let me direct the next question towards you. It's not that markets are down and we have redemption. Markets are high and yet we have redemptions. Do you think this redemption pressure is compulsive? Is this a shift in behavior? And will this spill over to the next quarter as well?
Nikesh, thank you for having me on the show. I'll probably combine both the views of Nilesh Bhai and Balasar and talk about what is happening in perspective of the fact that when you look at the equity flows into, especially from the mutual fund perspective, it has been 4 or 5 years of consistent net sales positive buying by investors. Let's face it, from almost 2015-16, investors have been buying mutual funds positively month on month for 5 years now. So I would not read too much into net sales negative for the last 2, 3, 4 months, but I would read more into the data with Nilesh Bhai said that, when the markets were at bottom, especially March, April, these were the times to buy. And let's face it, investors are bought, right? And then when you put people in a closed environment for 7-8 months, and you've seen the volatility that has unfolded, it can play on every minds of very pedigreed investors also. So we could be seeing some part of that. When you see a run-up like this, a lot of DIs would have also hit some of their valuation targets, and there could be some amount of selective profit taking in various stocks if their target prices have been hit. So it cannot be just one factor that is affecting some of the outflow at the market when there is such a sharp bounce back, and this time the bounce back has been a little broader than what the market was saying March and April. Some of us, some of our stocks have hit a target value, so we've been getting out of some of our stocks also. Though the inflows for us have been positive, doesn't mean that we are not selling. So the selling reasons could be varied, and it could be from a risk profiling perspective to a valuation perspective. It's a multiple reason for why money is going out, and it's natural that when money has been coming in for 4 or 5 years at a stretch, some amount of it will go out. We did some search, and fact is, from our investor perspective, I'm very happy to echo what Nilesh Bhai said. A lot of it which is going out is actually money which has made money. So it's all good if it goes out making money.
So Nilesh Bhai, when do you see things will stabilize? Do you think next quarter also things will be choppy, and it's only from the next financial year, which is April 2021, we could be in for a different change?
So again, mutual fund investors are not a homogeneous group. They are heterogeneous group. If I look at retail behavior, the peak SIP flows were 8,400 crores a month. The bottom SIP flows was 7,800 crore a month. Now we are back to 8,000 crore. So by and large, retail SIP flows have sustained. And there the average collection is about 3,000 rupees. On HNI and family office, there has been some redemptions to fund their other opportunities, including businesses which required support during COVID-19 period. Some of the institutional investors have also done profit booking. Now there is one more element to mutual fund redemption. We also run asset allocation products like Balance Advantage Fund. Now in Jan, we were at 40% allocation to equity. March, it became 80% allocation to equity. Today, it is back to 45% allocation to equity. Now, in this Balance Advantage Fund category, because market valuations have moved in a certain range, the equity allocations have come down. In our own case, we would have sold close to 1,200 crore of equities between, let's say, June, July, August to September, October in this particular fund. This is to bring equity allocation to neutral weight from overweight in March. As Swarup mentioned, this is the profit booking which we have to do because that is the mandate of the fund. Now, if you put all these things together, we do see normalization happening in retail flows. We do see normalization happening in institutional flows. However, the HNIs and family office space today is sitting on cash, and they have to get convinced that valuations of markets have actually improved rather than deteriorated with rise in index. Prior to September quarterly result, many investors thought equity markets were trading at 30-35 forward PE. The September quarterly profit for Nifty 50 companies came at 107,000 crore, all-time high in the corporate India's history. If I just annualize 107,000 crore into 4 quarters, that's 428,000 crore. On 100 lakh crore market cap of Nifty 50, that's a forward PE of 24, not 30-35. Now, the day family office, HNI, and other large investor gets convinced that this 1 lakh crore quarterly run rate of profit is likely to continue, I'm sure their allocation will also start shifting towards equity, and we will see normalcy returning in their allocation.
Mr. Mohanty, we've also seen that at a time when there is drought in the market in terms of fresh inflows, a lot of mutual funds have also decided to raise money via the NFO route. Is that trend here to stay?
No, I think I can speak for ourselves. When we looked at the COVID shutdown period, we did take this opportunity to plug some of the gaps that were there in the product basket. So typically, it's been a very different year for us. I mean, 8 products in 12 months is not something which we had done in the previous 8-9 years. So we took this shutdown to plug that gap, and I think we are at the end of it. As Bala rightly mentioned, we saw great opportunity in the banking side also. So we launched our last theme from our side and launched a banking fund as we speak. And all of us have been very bullish on the ESG space. Nilesh Bhai is in the middle of an ESG product. And see, most of the products which have come, and I'm very happy to say that, are very futuristic in mind. You look at all the product launches that have come are very different from the erstwhile product basket that have come from the industry. So it's each fund house to its own, and let's look at it. Now, each fund house is setting up its own powerhouse of ideas within themselves, and some of the powerhouses have started building some incredible track record. And some of the products which are coming now in the next 5-10 years will be very, very central and very core in the portfolios of the investors as the markets change. I mean, Bala has been reflecting on how the markets could get broad-based. In the broad-basing of the market, maybe some of the portfolios which will work in the future may not be those which are of the past. So it's in the earnest of, in the selfish interest of the industry that we put products which are time-tested and would be very futuristic in mind. And I'm very happy when I analyze most of the products in the market. These are completely keeping the future in the mind, and some of them will, I'm sticking my neck out on this, will really pave a very new path for the industry in the times to come, is my view. Whether NFOs will come or not, I think time will tell, but I do believe that on the passive side, we will see a very different level of products, very different level of thinking, and that side will be an exciting side to watch out for.
Nilesh, what will be your advice for those who are currently using the market strength to get out of some of the old investments? I mean, sometimes the psychology also works in a reverse manner, which is that you had made an investment because of COVID crisis, your investment went down by 25 to 30%. Now that it is back to par or you're making slight amount of returns, the natural tendency is to cash out.
So Nikunj, our approach has always been be a disciplined asset allocator. When markets are cheap, be overweight. When markets are expensive, be underweight. And invest according to your risk profile. I do believe that this is a great opportunity for India to convert crisis into an opportunity. All the catalysts for rapid economic growth are falling in place. Low interest rates, high liquidity, but banks still have to go out and lend. Foreign portfolio investment flows, foreign direct investment flows will be record highs, but we also need domestic entrepreneurs to invest. markets will rise, but not all companies will rise. You will still need to pick up right stocks. So my recommendation to investor is don't really give too much attention to news. Just follow your financial plan. Markets are markets. They will swing between optimism and pessimism. There will be bull's face and bear face going forward also. But if you maintain your disciplined asset allocation, it will always reward you.
Well, the big question is, while benchmark indices have given a great return, the question is still centered around what is the future for mid and small cap schemes. Do you think the time has come where we could see perhaps a rally like 2014 and 2016? 2013, nobody wanted to buy mid caps, and then between 2014 and 2017, we saw a absolutely stellar bull market in mid and small cap stocks.
Yeah, I think, Nico, very interesting trend that we see. I think what we have seen the last 1.5 years of pull up in the market was largely driven by the large cap. There is no doubt on that. Even today, the small and mid cap index are trading at about 25% discount to the 2018 peak, which means despite all the euphoria being there in the market, despite all the things that we are saying on which we are getting convinced that things are coming back in the economy, we still not seen the level at which it was trading in the market in 2018, especially this small and mid cap space. And as I mentioned earlier, that once it reach certain size, naturally the larger the companies, the rate of growth would come down or maybe will get stabilized. And the smaller the size, when the way I think the interest rates are currently is there, and the way I think transmission has happened in India, if you ask me, the biggest success that has come in India is the transmission of interest rates today is available for everyone. And that's something, the big achievement that has come in the last 6 months period. That benefit should accrue along with the government support that has come for MSMEs, also should boost the confidence of small and mid-sized companies for them actually to do well. So I think we are already in that stage. Probably the next 1.5 years period, as I mentioned earlier, the broad market, broad-basing the market happening, and the more and more people start looking at spotting opportunities outside the Nifty, outside the Sensex, even outside Nifty 100, would probably actually bring back the small and mid-cap company. At the end of the day, it has to be more stock-specific. Fundamentals of the company has to be good. I think as Swarup mentioned about earlier, the ESG kind of theme, but ultimately all of them will also be equally applicable for identifying companies in the mid and small cap space from management point of view, from governance point of view. I think all combination put together, and my view, I think we're already there for that segment to actually do better. I think one single factor in my view will drive, say, HNIs who have moved out, and then they will always have a struggle in terms of finding alternate investment opportunities. I think TINA factor, which I think is today, if you look at, there is absolutely no alternate, given the fact the interest rates are so low, given the fact that real estate as a segment is still not something where people go and put all their money, and therefore the equity asset class would come back, and that's why I think HNIs will come back and participate in the broader market, and that could probably, in my view, could be a trigger for the segment to do well.
Mr. Mohanty, what is your view on the way how the mutual fund industry, in a sense, has really adapted themselves in the COVID crisis? We all are working from home, and the mutual fund industry is also working from home. How difficult was it, and how difficult it was for you or your firm to really adopt to best practices sitting at home in terms of digital adaptation and in terms of innovation?
See, Nikoji, it has been a fascinating period. Let's go to the beginning. And when you look at Amphi stepping up at that moment and ensuring that the entire industry goes digital, to me was unbelievable, actually. I'm sorry I have to say this in front of both senior Amphi office bearers, but I was amazed that we could take this stand and go completely digital. Please understand, this has happened with the blessings of the regulator also. And nothing happened. The transactions were seamless. Please understand, a lot of us thought we were technological advanced, but my personal opinion is I knew nothing about technology. This COVID has taught me about technology, whatever little I know now. It was a very quick upgrade for the industry, for all of us. We've gone through our own share of infrastructure upgradations, but none of it spelled out to the external investors. Each redemption was met, each purchase was done, whatever was required within this constrained environment of working from home, which was completely new to us. I don't think there has been a single service glitch to any investor outside, and that's something which the industry has to step up and be very proud of. And all credit to the office bearers of the powers to be, both in AMFI and SEBI, to ensure that this has happened from an investor perspective. Let's face it, the dealing rooms went home. This has never happened in my entire working career. The risk was maintained in spite of all that. See, this is a fiduciary role that we all do. It is somebody else's money, and safeguarding that, as Nilesh Bhai rightly put, is our only responsibility. In that environment, to be in a closed environment and delivering business as usual, to me has been a very fascinating experience, and it's been a hugely learning experience, and I think something which will strengthen all of us going forward. We have learned so much within this period, and going forward, what will unfold post-COVID will be a different level of digitization. What has happened obviously is an upgrade, but this is now a given. The industry will now, I believe, take it from here and to a different level. A thing like an app and all are extinct now. We'll talk about bots going forward, and that's something which will unfold in a very, very structured manner, is my fundamental belief. And the best thing that could have happened from a digitization perspective has been COVID, and we've learned enormously from that. And I must give credit to the industry for standing together and delivering it together.
Every time when we've spoken about mutual fund industry in the past, the challenge has been that the mutual fund industry is not really, let's say, gone beyond 10, 12 cities. Is that trend changing? Are you getting a sense that the spread for the mutual fund industry, both in terms of applications and participation, has just gone beyond the major metros and mini metros?
Undoubtedly, Nikunj Bhai, now more and more of our AUM is coming from B30 cities. And obviously, change does not happen overnight. We need to gain trust and confidence of investors in B30 towns. Word of mouth publicity is most important for mutual fund. As I create one set of satisfied customers, they will bring another set of satisfied customer, and eventually this will become a chain reaction. When I started my career in mutual fund, which was after Bala is Bhishma Pitamo of our industry, my debt AUM was 37 crore. Today, it has grown to more than 2,15,000 crore. This journey will be true for Swarup also and Bala also. I'm sure when we started our career, we had no idea we will be managing this kind of money. And this has all happened because we were able to gain investors' trust, and a J curve eventually came into play. So the J curve has come into top cities. It is on the point of inflection in semi-urban India, and we have to go and build same trust and confident base in rural India. But eventually, mutual fund industry will become part and parcel of every Indian citizen's portfolio.
So Bala, before we wrap, no pun intended, really on the lighter side, when I started my career 20 years ago, you were a fund manager and you used to look different. Black hair, no white hair on your mustache. Now it's gray hair all over. So is it stress or is it wisdom?
Well, I think it's the enjoying working for the mutual fund industry, Nikunj. And as Nilesh mentioned, Nilesh was one of our first investors in Birla Income Plus when he was part of ICICI Securities. And incidentally, Swarup was also part of our team, and in the year 2003 and 2004. And where we were, the size, I think what as Nilesh mentioned, the size in which we were there, and size in which I think we are all there as industry, even 27 lakh crore for the industry. For Birla is about close to about 2 lakh 60,000 crores. The equity is about 90,000 crores. Would not have come but for the effort that all of us have put in, and also the conviction of the investors that investing in mutual fund is actually the best way to actually put their savings money into mutual funds. And that's something, in my view, has been a great journey, great success story for mutual funds. No doubt, the experience of investors will vary from time to time. If somebody is satisfied today, maybe about a year back would have been a dissatisfied customers, and not because the service of the funds would have been bad or something else. The market always go through the cycles. I was just looking at one of the numbers that somebody had put money in pharma funds about 3 years back would have made money. But had he looked at his own performance 1 year back, would have felt sad because pharma sectors 3 years did not do well. But as we look at today, it's been one of the best performing sectors for 1, 2, 3 year period. The same thing with banking and financial sector. If you look at 1.5 years back, if you look at would have done extremely well. Last 20 years bad, again comes back. I think this way I think market gives a different experience. Therefore, it's unfair to assume that this is the way somebody has performed. Therefore, somebody is good, bad. But the mutual fund is a great leveler of everybody. And as long as you are committed to build the business, as long as you are committed to apply some kind of process, and in terms of delivering risk-adjusted return to the investors, I think mutual fund will remain as a great platform to be there.
All right, now before I wrap, here's my analysis of the mutual fund industry. Yes, it's true that in the short term, mutual fund industry and some big funds have underperformed the benchmark indices. But that's how typically bull markets start. They start very narrow and the leadership really spreads. And that is what I think we are likely to experience when the economy will start opening up. The difference between the market breadth in last 3 months has been extraordinary. Markets are no longer relying on a handful of 5 or 6 stocks. And for genuine mutual fund investors, you should always remember that mutual fund is a vehicle where if you think long term, if you stick to your financial discipline, you will be able to reach your financial goals. Sometimes over-analyzing and analyzing the short term with a magnifying glass may not be the correct way to understand the power of mutual fund industry. So happy investing and thank you for tuning in.